Rick Santelli. Rick, kind of like the stock market, the bond market's probably used to it at this point, but at what point does it start to matter?
You know, I can't even guess at what point it starts to matter, but as previous guests have been saying all morning, pretty much we've seen this all before. It is a kabuki dance to some extent, but of course, if it lasts a certain amount of time, and I'm not sure what that timeline is, the markets might pay some attention. But today, they paid a whole lot of attention to weak ADP report, weakest since March of 23. In addition, a negative revision to last month, and markets were off to the races. Upside in price, downside in yield, Sully. And the big thing is, if you look at 2s and 10s on the same chart, is that 2-year yields dropped much more aggressively than 10-year yields. And even now in the aftermath, we're down about, 7 basis points in a 2-year. We're down about half that in a 10-year. And the reason that's so important is because weak jobs underscores the labor market weakness, which has been highlighted by the Fed over inflationary issues. So the 2-year yield dropping really gives us a notion of how important any weakness in the labor market is with respect to the current strategy of the Fed. But if you look at the dollar index on that same 12-hour chart, you'll notice it's come back. So it didn't pay as much attention. And by the way, all the percentages for Fed easing at the rest of the meetings this year were upgraded a bit. As a matter of fact, technically, we're over 100% on the next meeting, which means you're pricing just a smidge more than 25 basis points at the moment. And finally, 2-year and 10-year going back to the third week in August. If we closed right here, Brian, we'd be at a 2-week low yield close in 2s. We'd be at a 1-week low yield close in 10s, which underscores what the yield curve has been doing today in particular. It's steepening because short rates have dropped so much more. Back to you.